9 months after the Japanese government stepped in to stabilize the currency in 2022, the value of the yen against the dollar is declined rapidly again. The yen recently gained close to 145 yen per dollar. This is close to the level of 146 yen that Japanese authorities intervened in September 2022 to defend against the depreciation of the yen. The yen hit a 52-week low. The large volatility of the yen is due to the monetary policy of Bank of Japan, which is contrary to major countries. The U.S. Federal Open Market Committee will continue to raise interest rates, but the BOJ has not normalized the hyper-accommodative monetary policy despite signs of rising inflation. Japan fell into the worst vicious cycle of issuing government bonds again to pay off interest on government bonds. We can basically has the advantage of increasing the price competitiveness of exporting companies. This was used only when Japan was export powerhouse in the past. The weakening yen coincides with the period of high oil prices, negatively impacting Japan trade balance, current account balance, and inflation. There is also a prospect that the pressure to weaken the yen will weaken as the Federal Reserve's suspension of interest rate hikes becomes visible, putting a brake on the widening interest rates differential between the US and Japan. And if the rise in raw materials prices slows down and the trade deficit decreases, some observe that the BOJ will revise the yield curve control policy for reason of inflation, but considering the potential growth rate, there is a limit to lifting the negative interest rate, in particular due to the decline in the working age population and other factors. The potential growth rate that reflects economic power remains in the low 0% range. This is much lower than the US, which is about 2%. As the yen weakens, Japan foreign exchange authorities are increasingly wary of intervening in the exchange rate, as the U.S. Treasury Department removed Japan from its currency manipulation watchdog last month. The scope for intervention has also expanded. At the same time, however, some say that the fact that Japan is no longer under surveillance reflects a decline in national power. The main reason for being excluded from monitoring is the reduction of Japan's current account surplus, as the effect of boosting exports is limited even in the case of a weak yen. It is difficult to envision a scenario in which an improvement in the trade balance leads to a strong yen. Even industries that still have international competitiveness such as automobiles. Overseas production tends to increase, although the yen is cheap and dividends from overseas intervention have increased. Japan consumption has not expanded. Although interest rate cut is the root cause of the yen's fall, but it is not easy for the Bank of Japan to reverse its monetary easing policy. Even a slight increase in interest rates in Japan could lead to a serious national fiscal crisis. If the national bonds interest rates rises when the US raises it, half of the national budget must be used to repay the government bonds and pay interest, while long-term interest rates rose due to the U.S. Federal Reserve's tightening policy. The rise in Japanese interest rates was suppressed and the interest rate gap between the two countries widened, further accelerating yen selling. In the past, exporting companies earned foreign currency by selling more products based on the weak yen and then converted into yen to support the value of the yen. This law has also weakened. This is because Japanese manufacturing companies have moved their production bases overseas. Companies have become more inclined to reinvest the money they earn abroad. While wage growth in Japan is at a standstill, raw material import prices are rising, and the prices for the common people are also screaming. As Japan's yen continues to weaken, the dollar-yen exchange rate shows no sign of escaping from around 145 yen, the highest level in nearly 8 months. In the foreign exchange market, the Japanese foreign exchange authorities are increasingly wary of intervening. The Japanese exchange authorities can intervene in the market by playing 3 cards: strengthening verbal interventions, intervening in yen buying, and raising interest rates by the Bank of Japan. Among these, the use of verbal intervention reinforcement card is most likely. It is also unlikely that the government will intervene in the exchange rate by buying the yen. This is because structurally strong yen depreciation pressure, such as the U.S. interest rate hikes and export companies' overseas expansion, make it difficult to see the effect. If the government responds incorrectly, the fiscal burden caused by the huge national debt may increase. Japan's national debt to GDP ratio stands at 257%, the highest in the world, more than double that of the United States and the United Kingdom. If the base interest rate rises, the burden of repaying the principal and the interest rate the issued government bonds becomes heavy.